Welcome back everybody to Simplexity Analytics. In this video, we're going to take a look at one of the most popular indicators in the world of trading today, and that's the Williams percent R. It's also known as simply percent R or percent range. Percent R is a momentum oscillator. It seeks to identify the overbought and oversold areas in the market. It was developed in 1966 by Larry Williams, and it's an indicator that has truly stood the test of time, and it comes pre-installed on most trading platforms and websites. And here is what it looks like. Percent R fluctuates between 0 and 100%. Anything above 75%, which is indicated by this thin red line at the top, is considered to be overbought. Anything below 25%, which is this thin green line at the bottom, is considered to be oversold. This percent R is using a 14-period look back. So what that means is that it calculates the range of the last 14 periods, and it tells you what percent of that range the current close is at. For contrast, we are showing here the same chart, but this is from barchart.com. We're not picking on bar chart here, but we're just using it to show how most platforms use an outdated form of percent R. The actual line itself is correct, but you'll see that on the right side the values range from negative 100 to 0. Also, the overbought and oversold areas are 80 and 20. This isn't a big deal. The more extreme the overbought and oversold areas are, the fewer signals it will give. However, you will need to be careful, as some platforms even have the overbought and oversold areas inverted, with the overbought on the bottom and the oversold on the top. The next thing we need to point out is that by default, most of these platforms use the 14-period look back by default, as shown here. And this is a little out of date as well, as Larry himself has stated that he prefers a 4-period percent R. He explains this is because of increased market volatility in recent years, and as well as to produce more trading signals. He's the one that invented it, so it's best to heed his advice. Here is how a 4-period percent R looks. You'll notice that there are a lot more instances where the market becomes either overbought or oversold. The smaller the look back time, the more jagged the line, and the more extreme instances it will produce. What we like to do at Simplexity Analytics is to use both percent R14 and percent R4 together, and this is what that looks like. This way we can see how both time periods are aligning. Sometimes both percent Rs will be in the overbought and oversold areas at the same time. We've found these instances to have an even better success rate. So how do we trade all these fluctuations between overbought and oversold? The answer is that you don't trade all these signals. When the percent R is overbought, that means it's at an extreme area and that it's a sell signal. When percent R is oversold, it's at an extreme area, and that's a buy signal. But here's the catch. You only take signals that are in phase with the trend. Therefore, you only take the buy signals when it's an uptrend, and you only take the sell signals when it's a downtrend. Here's an example on a 10-year notes chart using our SimTrend momentum indicator. This would work with any other momentum indicator as well, or even with a simple moving average. When the trend is up, as identified by SimTrend turning green, we look for oversold conditions, and those are buy signals. And when the trend is down, we look for overbought conditions, like this, and those are considered sell signals, and those end up being very good sell signals. Here's an example from the gold market. We have a downtrend. Remember, in downtrends, we look for sell signals. Sell signals are when the markets are overbought. Uptrend, we look for buy signals. Downtrend, sell signals. And here's two great sell signals here in the middle of this trend, which ended up being very good trades. And again, in the wheat market, downtrending market, we look for the sell signals here, here, and we got one here near the end of the trend. All very good trades. Uptrend, we look for the buy signals here, this area here. We had more good trades in this one as well. The disadvantages of percent R is that it produces a lot of false signals. This is why we need to use the trend to help us filter those out. Percent R is also an indicator that needs to be used in conjunction with or part of a larger trading system rather than just simply a standalone trading signal. Percent R is a great indicator, and it's one that we use here at Simplexity Analytics daily. It's best used in a trend following system, which means make sure the trend is established and then look for your entry signals with percent R at that time. Thanks for watching. Remember to like and subscribe and hit that notification bell so you're notified on our next videos. Simplexity Analytics, making complex trading simple.